Good day, everyone. In this session, we're going to discuss some national income accounts. We have the gross domestic product, or the GDP, the gross national product, or the GNP, the gross national income, or the GNI, the net domestic product, or the NDP, personal income, or the PI, and the personal disposable income, or the PDI. So these accounts are important to consider in measuring how well is our economy is performing. So these are some important national income accounts that we need to consider in measuring the performance of our economy. But before we're going to proceed in discussing each of these accounts, let's first define what is national income accounting. So actually, the national income accounting refers to the process of evaluating or assessing the economic performance, like how our economy is well performing by measuring its economic activity, such as the economy's production, expenditures, and income, as well as the national income accounting records the annual flow of goods and services over a specific period of time. And these activities can be explained in the circular flow diagram, wherein it consists of transactions from each sector of the economy, including spending or even earning an income. It also considers how our goods and services flow within the economy. So that is why it's called circular flow diagram. So take note that we study national income accounting for the reason that the national income accounts provide the formal structure for our macro theory models that we are going to discuss in the fundamentals of economic development or even in the basic macroeconomic course. Another, the national income accounting provides information on the performance of the economy because, again, it evaluates how our country is performing or even the well-being of our country in terms of the economic point of view. So the national income accounting considers in evaluating the performance of the economy using the following macroeconomic indicators that we mentioned. So we have the gross domestic product, the gross national product, the gross national income, the personal income, personal disposable income. And these indicators help to describe the state of the economy. So now let's start with the gross domestic product. So we all know that the gross domestic product is the total market value. So meaning the final goods and services are measured in terms of monetary terms. So we have to account the market value of all final goods and services. So when we say final goods and services, it's actually intended for the end user, or these goods and services are ready for final consumption. So these final goods and services are currently produced within a country. So meaning it's within the boundary of the country. So it's produced domestically in a given period of time. And the gross domestic product has four components. So we have here the C for consumption, I for gross private investment, G for government purchases on goods and services, and NX for the net exports, where the net exports is actually the difference between exports and imports. So it is computed using the formula where NX is equivalent to export minus the import. And these four components of the GDP actually involves spending or expenditure. Again, the GDP accounts all expenditure or spending within the economy. So we have here consumption, like the consumption of the households for goods and services, even the spending of businesses through investments, like they're going to spend to make more goods and services or to make business. And we have also the government sector that purchases goods and services, to support its program, and even to promote public welfare. And we have here the net exports, which involves transaction with the foreign trade sector. Either we're going to exports and import. So now, let's proceed with the gross national product. So in the gross national product, or the GNP, it's actually the same with the GDP. It accounts the total market value of all final goods and services produced within a given period of time. However, these goods and services produced within a given period of time considered the factors of production owned by a country's citizens or the nation's citizens, regardless of where the output is produced. The difference of gross national product, or the GNP, from the gross domestic product is that the gross national product focuses on the value of all final goods and services produced by its nation's citizens, whether that citizens or nation's citizens are within the country's border or in abroad. Like for example, the Philippine GNP, rather, the Philippine GNP accounts the output produced by the Filipino citizens, whether they are here in the Philippines or even in abroad. Like for example, a Filipino company operates in China. Of course, the output produced by the Filipino company in China will be reflected in the gross national product, because again, it's the nations, no? It's the output produced by the nation's citizen. However, the output produced by the Filipino company in China will not be accounted in the gross domestic product of the Philippines, because again, that product made by the Filipino company in China is actually made in China. So but the output there reflects the value of output of that Filipino company reflects on the GDP in China, not in the Philippines. So that's the difference between the two. In gross national product, it accounts the market value of all final goods produced by the nation's citizens. So the keyword here is nation's citizens, whether they are within the border of that nation or in abroad. However, that is why it's more on gross national product, national. So the output is produced by the nation's citizen. Unlike with the gross domestic product, so from the word domestic, so it's the products or the value of goods and services accounted or should be produced domestically or within a country or within the border of a country. Like for example, if the product is made in the Philippines, then the product should be reflected in the GDP. Even though the company is a foreign or a Filipino company, still, as long as the output is being produced in the Philippines, still, it's part on the GDP. Okay? So let's go with the formula. So here, we can see that the GNP is a sum of the GDP plus the net factor payments from abroad. So when we say net factor payments from abroad or net factor income, it's actually the difference between what country's residents earn abroad and what foreigners earn in that country. Like, for example, the income of residents abroad, let us say 5 billion, while the income of foreigners within the country, let us say 3 billion. So if we're going to get the net factor payments, it should be 5 billion minus 3 billion. So the 5 billion here is the income of residents abroad, nations residents abroad, and the 3 billion is the income of the foreigners operating within the country. So the net factor payments now here is 2 billion, and this will be added on the GDP so that it will result into gross national product. Okay? So another important national income account is the gross national income. It's actually the same with the gross national product, where it measures the total income of the nation's citizens or even nation's businesses. But in gross national income, it involves accounting indirect business taxes. So we're going to deduct the indirect business taxes from the GNP. So when we say indirect business tax, this is actually the tax levied on businesses. Like, for example, we have license fees, sales tax, custom duties. And of course, for example, when we buy goods in a mall, we actually pay sales tax or even value-added tax. Here in the Philippines, we have 12% value-added tax for our purchase of goods and services. So instead of paying that value-added tax to the Bureau of Internal Revenue or the government sector, we pay it to the business or to the store, and the store will remit the taxes that we paid to the government. So that is why it's called indirect business tax. Like, we do not pay the tax directly, we do not pay the tax directly to the government sector, but rather than we pay the tax through the business, no, and the business will remit it to the government sector. So that is why the sales tax, value-added tax are examples of the indirect business tax. Okay? So now let's proceed with the example here. So let's compute gross domestic product, or the GDP, the GNP, and the GNI. So first, let's compute the GDP, or the gross domestic product. Again, the GDP is the sum of consumption, gross investment, government purchases on goods and services, and the net exports. So the GDP here, we have the C. So on the given, we have 900 billion. So assuming that these are measured in terms of 900 billion. And here we have the I, or the gross investment. Take note, in the given, we have net private investment. And net investment is different from gross. So to compute the gross, we have to add, to make the gross investment, or the I here, we have to add net private investment and the depreciation. So we have here 300 billion plus 100 billion. So that is 400 billion. So in getting the I, so we have here 300 billion plus 100 billion. Then we have here the G, which is 300 billion. And the net exports, again, the net export is the difference between export. So the export here is 200 billion. And the minus the 150 billion, which is our import. So we have here our consumption, 900, our gross investment. So we have here $400 billion. Our government spending for goods and services, 300. And for the net exports, 200 minus 150, we have here 50. So if we are going to add this, so we have 900 plus 400 plus 300 plus 50. So our GDP now is 1,650 billion, or it's actually 1.650 trillion. So that's it. This is now the value of our GDP. Now we're done with the GDP. Now let's proceed with the GNP, or the gross national product. So again, the GNP is equivalent to the GDP minus GDP plus the net factor income abroad. So here we already computed our GDP, which is 1,650 billion. Plus, we're going now to get the difference between the income earned by residents and the income earned by the foreigners. So we have here 60 billion. So this is the income earned by residents minus the income earned by the foreigners within the country. So we have here minus 40 billion. So the net factor income here is we have $20. So in computing our GNP, so 1,650 plus $20, we have here 1,670. So 1,670 billion. So this is now our GNP. So, okay. So last, we are going to compute the gross national income. And the gross national income is equivalent to GNP minus the indirect business taxes. So actually, we already computed the GNP. So we just simply deduct the indirect business taxes from the GNP, which is actually 50 billion. So 1,670 minus 50, we have 1,620 billion. So this is now our GNI. Okay. So I hope that this illustration is all clear. Okay. Now let's proceed with the other national income accounts. So first, let's talk about the net domestic product. So when we say net domestic product, this is actually the net between the gross domestic product and the depreciation or the capital consumption allowance. So here, the depreciation or capital consumption allowance was being deducted from the gross domestic product. So when we say depreciation, these are the parts of the output that are used to replace the worn out capital goods, because capital goods like machines, equipments, over the years, they will be depreciated, meaning their value will be lessened. So that's the depreciation or the capital consumption allowance, which will be deducted from the gross domestic product to get the net domestic product. Sometimes if the net private investment is given, we just simply, to get the net domestic product directly, we just simply do not include the depreciation or the capital consumption allowance. So again, we have here NDP is equivalent to GDP minus the depreciation. So another national income account is the personal income. So this is actually the gross income that accrues to the household coming from the factor payments, or from the factor payments. We have the salaries for labor, rent income. We have also interest. We have also proprietor's income for sole proprietor entrepreneurs. So, or even dividends, the share of profit earned by those stockholders. And even though we have to consider the transfer payments or the non-labor income that is being transferred by the government to the household. Like for example, social security benefits or the unemployment benefits. So the government just simply transferred the money from the government sector to the household. So there's no goods and services involved. But this transfer payment, since the household earned these transfer payments, could be part of the personal income. So however, if these factor payments are not given, you can use the other alternative formula wherein the personal income is equivalent to the gross national product minus the depreciation, minus the indirect business taxes, minus the corporate income tax, minus the social insurance contribution, minus the undistributed corporate profits, and plus the transfer payments. So we actually deducted the indirect business taxes as well as other income or taxes related to a corporations, because a corporation is a different entity, so it's not part of the personal income. And another important national income account is the personal disposable income. So this is actually the total income left to the households after deducting the taxes and even other personal charges. And also we add the transfer payments here. So this is also known as the after-tax income or the net income after the tax has been deducted. So that is why the personal disposable income is equivalent to personal income minus personal taxes. Or if there's no given in terms of personal income and personal taxes, but there's a given for consumption and savings, so we just simply add consumption and savings, because in the personal disposable income, we use this money either for present consumption, like for consuming goods and services, and for the future consumption. So that is why we save. So again, after the tax has been deducted in our personal income, we use the remaining money for either consumption or savings. So now let's proceed with the examples. So we have here the gross domestic product, depreciation, net factor payments from abroad, corporate income tax, social security contribution, undistributed corporate profits, transfer payments, and indirect business taxes, as well as personal taxes. So here, we're going to compute the net domestic product, personal income, and personal disposable income. So first, let's compute the net domestic product or the NDP. Again, the NDP is GDP minus depreciation or capital consumption allowance. So again, our gross domestic product here is measured in terms of billion. So we have here 2,000 billion minus 200 billion. So we have here 2,000 minus 200. Our net domestic product here is 1,800 billion. Okay? So that's our net domestic product. So now let's compute for the personal income. So given that the factor payments are not given, so we will be using the other formula wherein the personal income is equivalent to, or the PI is equivalent to, so I'm going to fix this one, no? PI is equivalent to, we have GNP or gross national product minus the, of course, we have minus the depreciation minus the corporate income taxes minus the social security contribution minus the undistributed corporate profit, and we add now the transfer payments. Okay, so for the GNP, again, in computing the GNP, we have to add the GDP and the net factor payments. Then we add here, we deduct depreciation, CIT, SSC, UCP, and add the transfer payments. I think if there's an indirect business tax, we have also to deduct IBT rather here. So we deduct indirect business taxes. Sorry, I forgot to include here since it's given, no? So here we have the GDP. So GDP, so we have here 2,000 billion plus the net factor payments abroad. We have here 100 billion minus the depreciation, which is 200 billion minus the IBT, which is the 50 billion minus the CIT. So here we have the CIT, corporate income tax, 150 billion minus the SSC or 120 minus the UCP or undistributed corporate profits. We have here 80 plus the transfer payments 200. So we have here 2,100. This is now our GNP minus the depreciation minus the indirect business taxes minus the corporate income tax minus 120, which is our social security contribution minus the undistributed corporate profit, which is 80 billion, then plus transfer payment. So if we're going to solve all of this, our personal income is now $1,700 billion. Okay. So next, we're going to solve for the personal disposable income, or the PDI, disposable income. Okay, so since the given here is only personal taxes, there are no consumption or savings, so we will be using this formula. So PI minus personal taxes. Since we already solved for the PI, so we have here 17 minus 300 of the personal taxes. So our PDI here is 1.4 billion, or 1,400 billion. So this is now our personal disposable income. So I hope that you learned something on this example. So before we end this video, let's now proceed with the last example, computing all the macroeconomic data. So we have also to include the GDP, the gross national product, and also the gross national income, so that we can also solve for the net domestic product, personal income, and the personal disposable income. So first, let's compute the GDP. Again, the GDP is the sum of the four components. We have consumption plus investment plus government expenditure plus the net export. So here, our consumption, we have 1,500 billion, plus the investment here, we have 700 billion, plus the government spending for goods and services, 500 billion, and plus the net export here. So we have here 300 minus 250. So solving all of this, so again, 300 minus 250. So we have here 50. So solving all of this, our GDP is equivalent to $2,750 billion. Okay, so that's for the GDP. Now let's proceed with the GNP, or the gross national product. So again, the gross national product is equivalent to GDP plus the net factor payments abroad. So we have here, in our given, our GDP is already computed, which is 2,750 billion. And we have our net factor payments from abroad, which is 20 billion. So our gross national product is 2,770 billion. So this is now our GNP. Okay. So now let's proceed with the gross national income. So the gross national income is the difference between the GNP and the indirect business taxes. So we have here the GNP is 2,770. So I'm going to make this clear. So we have here 2,770 billion minus here we have 60 billion. So our GNI now is 2,710 billion. So this is now our GNI. So next, let's now proceed with the net domestic product, or the NDP. So again, the net domestic product is the GDP minus depreciation. So here we have the GDP. We already computed the GDP, which is $2,750 in billions minus the depreciation. So we have here 300 50 billion. So the value of our NDP is actually equivalent to 2,400 billion. Okay, I no, not okay, I think that's correct. So 2,750 minus 350, so we have 2,400 billion. So this is our net domestic product. So another, let's compute for the personal income. So in the personal income, the factor payments are given, but the other transactions like the corporate income tax, the social contribution, undistributed corporate profit, and etc. are not given. So we will be using now the transfer payments, the factor payments, sorry. So we will now be using the factor payments. Like here, we have the salaries plus the interest plus the rent plus the proprietor's income plus dividend plus transfer payments. Again, these are actually the factor income payments. So considering this formula, so we have here salaries 1,200 plus the interest 200 billion plus rent 150 plus proprietor's income 250 plus the dividend 180 plus the transfer payment 220. So our personal income now, so this is our PI, is equivalent to 2,200. So let's check. So 12 plus 200 plus 150 plus 250 plus 180 plus 220. So we have here 2,200. Lastly, we're now going to proceed with the personal disposable income or the PDI. So here, we can use now the given personal taxes. So we have here also the personal income. So PI minus personal taxes. So we have here 2,200 minus 400 billion. So our PDI here is 1,800 billion. Again, we are going to put billion. So I forgot to put billion here. So this one also going to put billion. Another, since consumption and savings are given, we can use that formula. So our PDI is equivalent to consumption plus the savings. So PDI is equivalent to 15 plus 300. So we have here 18 billion. So see, they yield the same answer. Okay? So I hope this ends our discussion on the important national income account identities. So I hope that you learned something about GDP, GNP, GNI, NDP, PI, and the personal disposable income, especially in computing those things. So once again, a pleasant day to everyone.